Good morning, everybody. Welcome to this morning's session, Actuaries and Human Dignity in Older Age. We're going to kick off the session by discussing a paper that was published in the Harvard Business Review in 2014. It was a paper by Professor Robert C. Merton, the Nobel Prize laureate. It was titled "The Crisis in Retirement Planning." Now, Professor Merton in this article speaks about the fact that the dot-com crash in 2000 really focused corporate pensions, at least in the United States, on what the true cost of their pension obligations were, particularly in the defined benefit schemes. What we saw was that people living longer, a fall in interest rates, and an equity market crash resulted in a number of high-profile US companies going into bankruptcy. General Motors, the state of Detroit, even in the UK, we saw that British Airways was at one stage regarded as a pension fund with a big deficit that happened to have a sideline airline business. And this accelerated the movement from defined benefit to defined contribution internationally. So we had Sahaj, a member of his company's defined benefit fund on a Friday, suddenly become a member of the company's defined contribution fund on a Monday. Now, the purpose of the two funds was identical, yet the experience of Sahaj was completely different. On Friday, he had the board of trustees, the financial director, consultants, and a number of other stakeholders looking after his retirement benefit. On Monday, Sahaj was largely left alone to make all of the decisions himself. Now, what does this mean? What does this mean for individuals going into retirement in their old age? Well, I'm delighted today to introduce an esteemed panel of speakers that's going to help us guide the debate. We have Professor Nielsen from the Cass Business School. He's going to talk about a number of ways of framing the question to us and how we can take work done by Professor Merton forward. We have Gautam Bhardwaj from Pinbox Solutions. He's going to look at the solutions and how they can be rolled out at grassroots level. We have Preeti Chandrasekhar, who's going to give us a different perspective on the retirement and how people can have dignity in their old age, and that's going to be from a local perspective. And then Kulin Patel from Willis Towers Watson, he's going to take us forward and look at the debate holistically. So I'd like to share my own personal story, and it talks about the concept of important versus meaningful information. As part of our country's medical testing, when I say our country, I'm from South Africa, every year as part of my medical scheme, we go and we have a number of tests. We have an HIV test and we have a cholesterol test. And the very first time I went to take my cholesterol test, I sat down with a nurse in her office. She pricks your finger, a little bit of blood comes off, and it goes onto one of those devices over there. And you wait anxiously for the number. The HIV test is the more stressful test as you're waiting. There's no reason why I should have it, but you wait for that line to show. The next one is the cholesterol test. And I must say, I've never had a cholesterol test in my life, and out comes the number 7.4. And this nurse, who had been incredibly friendly, jovial, joking, laughing, suddenly had this very stern-faced expression as she looks at me and she says, "This is your cholesterol number." And I look at her and I go, 7.4, is that good, right? Is that out of 10? 74%. It's like almost a distinction, if 75% is distinction. She looks at me and she says, "Mr. Leviton, you told me earlier you speak about retirement. You work in retirement." So I say, "Yes." She goes, "If your cholesterol stays at this level, you're not getting to retirement." And all of a sudden, your attention turns to shock. This number that meant nothing has suddenly been told is a lot. So you say, "Well, what is normal?" She says, "Somewhere between 3 and 6, but at your age, you shouldn't be showing a number of 7.4. So I turn to her and I say, "Well, what can I do?" She says, "Well, there are a number of things you can do. You can exercise more, you can eat better, you can take medication like statins, and in fact, you should do all three of them. Do that, and then come back in 6 months' time, and we can do the cholesterol test again." Now, this analogy, which spurred me into action like you've never seen before. All of a sudden, our whole house had things thrown out, I've never seen more fruit and vegetables brought in. It's changed the entire way we eat in order to bring the cholesterol level down. This is the same experience that members of defined contribution plans have internationally, where they've been presented with accumulated account balance, things like volatility, standard deviation, past performance. They get given benchmark returns, and they're expected to somehow know what to do with this information. In South Africa, we communicate pension benefits with something called the replacement ratio, which I'm sure any of you in pensions are familiar with. But for those of you that are not, it shows you what your expected pension as a proportion of your salary at retirement is expected to be. And as long as that's above 70%, you're deemed to be pretty good. The problem is that in South Africa, many people don't understand percentages. And even if you do understand percentages, that percentage is as a proportion of what we call a pensionable salary. I believe you call it the basic salary here in India, which is different to the total cost to company. And by the time you've put all the caveats together, even communicating things like replacement ratios becomes problematic and people don't understand it. Ask a member of a defined benefit fund what they were on track for in retirement, they could tell you a percentage of salary. Ask a member of defined contribution fund what they're on track for, and they sadly tell you an account balance. It tells you nothing about the level of income they're on track for. But now if you showed them income, and the income they're on track for is much lower than what they expected, they suddenly take the same thing that I did with my cholesterol test. They go, I can't live off 2,000 rupees a month, I need a few thousand more. What can I do about it? You can say, you can save more, you can work longer, you need more investment risk in your investment strategy. And for all the innovations and clever optimization technology that exists, and we've implemented those solutions along with professors around the world, none has been more effective than changing the way we communicate with people from the way that we understand it as actuaries to the way in which they understand it as individuals in terms of income. So we've seen the whole world change. We've seen efficient use of data and technology. We've seen how companies like Uber, Airbnb, Netflix, Hulu, iTunes have changed the way in which all of our hotel accommodations, bookings, digital content is given to us. The one industry that consistently lags the rest of the world in terms of technology and overhaul is retirement provision. And I'm arguing that we can take all of this impressive data that we have. I heard yesterday how TransUnion can take data from individuals and use it to come up with all sorts of credit exposures. The same can be done in retirement provision to start giving much better information. So we have a concept known as mass customization that we're seeing around the world, and that is that how do we deliver cost-effective solutions to individuals, make it bespoke, not one-size-fits-all target date funds or balance funds for individuals in retirement plans. There's a way of taking individual data, looking at a member within a fund, whether you're in the formal and informal sector, and coming up with bespoke investment strategies. The work there is beyond the scope of this session, but it can be done, and I'm delighted to now call up Professor Nielsen, who's going to share his perspective of how things haven't gone so awry, because the perspective I shared was from defined contribution markets. He is, as he describes, a kid of defined contribution, and he can share a different experience with us now. So thank you, Professor Nielsen.
Thank you very much, Sean, for the nice introduction. I think we are facing something exciting here. We are facing a moment where it's clear that the opaque and hard to understand pension system actually doesn't need to be so hard to understand. Sean was going through yesterday, very late though, so there were not so many of you, but he was going through that pension does not need to be so complicated. It can be understood by people. And Professor Merton asked for that in 2014. It's fair to say that his article in Harvard Business Review in 2014 was more like a vision than a really scientific paper, because he said it has to be easy, it has to be understood, it has to be based on income, everyone should understand it quickly. I'm from Denmark. When I was a young actuary, I was actually an appointed actuary at one point in a company doing defined contribution scheme. We knew nothing but defined contribution schemes. So I've been fighting, working all my life on how to improve defined contribution schemes. So it's not like any news to me that you have defined contributions. Defined benefit, we always found them old-fashioned in my country. However, at the moment now the entire world is looking at defined contributions and trying to find solutions to how to provide them to customers in an easy way. And now we're in India, which is very exciting because you don't need to go back in time and take solutions which are outdated. There's a much simpler way forward for you. And Sean represents one version, I represent another version, and there are a number of other versions available in the near future. Please don't take the old, outdated ones, okay? What I'm just going to mention is I'm part of an IFOA grant, Institute of Faculty of Actuaries, that supported us with around £1 million to do research into this area. And what you see in front of me is my version of Merton's. He did a vision in 2014. This is my vision right now. So what we need is a short conversation with the customer. It cannot take more than minutes. From that conversation, you should be able to back calculate everything financially. And that conversation should be about the customer, about his future, what he wants, how much money does he need for sure, what is his dream, right? That's the conversation. It takes a few minutes, and everything is done. Also, we have to keep costs down. So every time there's an intermediate provider of something, you have to be careful. Most of the time, you don't need it. What we do research into is, if there's something like a guarantee involved, don't buy it. Do it between the people. It's going to end between the people anyway. So do an arrangement so you're supporting each other. You don't need an intermediate to do the calculation and take their share. You don't need that. It's your money anyway that are being moving around, so why not just moving around yourself? It's free. So what we're doing research into is how to do an investment guarantee for free without expensive intermediaries. The same thing with mortality risk. I tried to introduce the concept in my own country, but actually the truth is we've pretty much done that for the last 40 years. The principle of mortality pooling. So we don't have expensive. In Denmark, where I come from, we don't have expensive overlays on mortality. It's just between the people. Finally, what we're doing research into is investment dynamics. How in this complicated world of all kinds of investment vehicles, how do you make sure that the conversation keeps simple? We don't want to hear anything about the investment vehicle. We just want to know that it's done by good people, and then we want the same short conversation, taking a few minutes about what you need and what you dream, and everything else is solved. So this is our research proposal that we're doing for IFOA. We're going to finish those 4 things in a year. Of course, we already know how to do it. Now we're writing up the papers. Finally, I want to say, now we have Mercer coming in a second. I'm proud to say that Denmark was voted number 1 in the world for pensions for the last 5 years, I think, by Mercer. Anyway, thank you very much.
Thank you, Professor Nielsen. So, as Professor Nielsen just said, he was speaking about Denmark, a country that's been ranked number 1 in the world for the last 5 years. We're now going to speak to Gautam Bharadwaj, and Gautam is at grassroots level because, of course, investment risk management is important to all sectors of society, and he's going to share his perspective of dealing with lower financial literacy in jurisdictions such as Asia, Africa, and right home here in India.
Thanks, Sean. Morning, everybody. So what I'm basically talking about is people who are actually not currently covered by pensions. And I think this population also is completely excluded by insurance. We're currently working in about a dozen countries between Papua New Guinea and Ghana. And this is how the pensions landscape currently looks. We're looking at out of about 1.9 billion working age individuals between Africa, Asia, and Latin America. We've got about 1.75 billion people who are currently excluded. So in this photograph, what you see is that there are some people who are in the formal salaried workforce who are covered by pensions, and there are certain people who are not covered by pensions. Everybody who's covered by pensions is actually sitting inside that train and sitting in some compartment or the other. Everybody else is actually excluded. So what we find is that regardless of which country we are dealing with in the developing world, we find that the governments typically tend to struggle to figure out how to actually solve the problem. Now, they don't have good quality pension systems which can easily be expanded beyond formal employment. So one approach that we've been discussing with governments is, can we leverage and harness existing digital financial inclusion infrastructure? Now, what's happened is that billions of dollars have been spent over the last decade in getting all of these countries up to speed on access to banking, digital payments. Most countries have very well-functioning digital national IDs. So can we use, and of course they have insurance firms, they have fund management companies and so on and so forth, but typically, as it happens even in India to a certain extent, it's very difficult to go beyond the metros. So as a result, most of the population which is in remote rural locations typically tends to get left out. So one way for governments to contemplate and imagine a more inclusive, shall I say, pension and insurance architecture is where you leverage existing pieces of the solution. And you will find, if you did a sort of a checklist, you'll find across countries, most of the pieces that are required in the ecosystem to create a genuinely inclusive pension and insurance framework already exist. Most countries have a digital ID. They have the traditional well-governed pension, fund management structure. You have good regulators. You have banks. You have mobile money providers, and so on and so forth. And of course, you have finance product providers. So it's feasible to integrate all of these and use technology to provide a single window interface to an individual for opening an account, for getting services, and so on and so forth. So, in fact, Rwanda was the most recent country to launch a national, completely paperless and cashless pension scheme. In fact, it's the first digital pension scheme in Africa. And I'm very happy to report that today you can use a USSD. You don't even have to have a smartphone. You can use USSD in opening a national ID linked pension account from anywhere in the country in under 1.5 minutes. That's the transaction time it takes. And that goes back to what Sean was also mentioning, and so was Lenz, that if we can make it easier and simpler for people, and I think considering the size of transactions that we are seeing, I think technology is the only way forward. There are other possible utilities. Once you've created an inclusive framework, you can do a lot more. You can have more targeted fiscal incentives that can be delivered in the form of, say, co-contributions and so on and so forth. You can have a lot of behavioral triggers. For instance, interesting things that we've done in Rwanda are we've created the concept of a pension bill. So you actually receive an invoice like you receive an invoice for any other utility payment. And this is tending to prompt better savings behavior. The second thing what you can do is once you've got technology, then you can actually start leveraging that technology for better outreach. One of the questions that was posed is around financial literacy or retirement literacy. Can we please play the video? Let me show you how this can be used. Could you please play that short?
This is Shanta. She's 22 years old. She lives in a little village far away with a husband and 3 children. But her family struggles to make ends meet. So Shanta decides to migrate to your city in search of work. You employ her as your maid. She works long hours. She takes care of your children. She cooks your meals and keeps your house clean. She sends most of her income back home to support her family, to put food on their table and send her children to school so that they may have a better life than hers. She does this year after year after year. When she's too old to work, Shanta returns to her little village. Her children are now grown up. They are educated and married, but have migrated to other cities. Shanta and her husband now live alone. But with no savings of their own, they struggle to make ends meet. they'll live without dignity and will live this way for the rest of their lives. But does it really have to be this way? Let's see this again. You employ Shanta as your maid. You talk to her about the importance of setting aside a small part of her income for her old age. And you spend just 10 minutes on the internet to help her open her own micropension account. And so, Shanta starts saving every month for her old age. Her savings are managed by the likes of LIC, UTI, and SBI and will grow over the years. When she's too old to work, Shanta will return home to her little village. She and her husband will still live alone, but they won't struggle to make ends meet. Because of Shanta's micropension savings, they will now get a monthly pension and will live with dignity for the rest of their lives. This could be the story of your maid, your driver, your gardener, or guard. Just 10 minutes of your life changed 20 years of Shanta's life. You can be that change. Gift Shanta a micropension account today. Her clock is already ticking.
So I think, and we did this as we were running a micropension program in India, in fact, with UTI, and we had 2.5 million informal sector, low-income people who were in this program. And when we launched this, within 3 months of a pilot, we had almost 30,000 people like yourselves who actually spent some time with their domestic help and helped their domestic help to open a pension account. And if we could all do this, if each of us could do this just for one person, in India, you've got 40 million people who work as domestic help. By this weekend, you could actually end up with 40 million people in a pension program where the overhead for each of us is just that tiny. Okay? Now, another thing which I will just end with this, and I've already warned my panel about my problem with brevity, but I will end with this, is that, so what you see here is a pension goat. And when we were running this program, what we found was that we were spending a lot of effort in trying to convince people about regular savings and the importance of regular savings. An important aspect in savings regularly was also inflation indexation of savings. Now, this happens automatically if you're in the formal sector, where your savings are a percentage of your income, or your contributions are a percentage of your income. But in the informal sector, you sort of generally decide, I can save 500 rupees a month, and then you tend to continue to save that 500 rupees. And you don't really realize that the real value of that money or that saving is coming down over time. We found there was this lady called Shamina Bano, and Shamina Ben was in a little village somewhere on the outskirts of Bangalore, in a place called Tumkur. And we found that Shamina was one of those unique customers who was actually inflation indexing her savings. And we were actually quite puzzled. We said, she's saving regularly, and she's inflation indexing. This is really fantastic. So we went and met her. And we said, Shamina Bano, how are you actually doing that? She says, Gautam bhai, what I do is I run a small goat farm. And every year I designate one goat in that goat farm as my pension goat. And when Eid comes, I go to the market and sell my goat, and whatever money I get from that goat, I put it into my pension account. And I do this every year. And that was a fantastic way. And we had not suggested that you should set up a pension goat. We were just saying you should save for old age, right? And then we said, okay, but how are you inflation indexing your savings? And she said, well, it's very simple. I'm not doing anything. You see, if I sell my goat for 2,000 rupees this year, it automatically sells for 2,400 next year and 2,750 the year after. And the inflation indexation is built into the market price of the goat. And I think that's fantastic. So I think if we can get things right, my sense is people will internalize those things and behave in a manner which makes perfect sense to them. And I think in that, I'd like to hand over to Preeti, who will talk a little more about Mercer's experience in India.
Thanks, Gautam. First of all, at the outset, I should admit that it really feels nice to be amongst panelists who are so erudite and experts in their respective fields. I'm honestly flattered. So I would like to give a slightly broader perspective on the entire concept of living with dignity in old age. And for that, I would just like to share this picture that I picked up from the internet. This picture that I picked up from the internet, I feel it's an extremely powerful way of saying that, and so just to give a background about these two people, they are a healthy old couple, childless, and they recently apparently wrote to the President of India requesting that they wanted a doctor-assisted death, or in some sense a dignified death, because they were worried that once they really get ill, they will actually have nobody to take care of them, and they didn't want to die that kind of a death. So which led me to think that, is dignity all about just getting enough money post-retirement? Is it just about the amount of pension I get or whatever returns, or does it go beyond that? For me, dignity is not just about the financial aspect, it's also about the social one, how acceptable I am in the society when I grow old. What about my physical wellness? So for me, dignity means all aspects of well-being. So you're talking about financial, social, physical, and mental well-being. I think all of them are important and all are correlated. If I don't have money, I will obviously be stressed and I will not be able to take care of my health. And if I don't have money, chances are that socially also there will be not too many people bothering about me. So if I look at the corporate sector, I, as a part of my job, interact with a lot of people, senior people, HR colleagues, who just say that, the worry for most people who are retiring and who actually don't think that they're going to continue with some kind of a part-time or an otherwise kind of a job, they say that today I don't have time for anybody, I am so busy. But tomorrow when I retire, chances are that the others will not have time for me. So how do I handle that? So these are all the aspects that are very important for us, that we need to take cognizance of while we are in our active years of employment, to see that we are both mentally, financially prepared to be able to handle these things. So this portion is about, all the stuff that I have put here is based on the interactions that we keep having with companies and the kind of various, the various research elements that we have as a part of our work. So 4 dimensions I would like to point out over here about India Inc. What is happening here is, one, we have a multi-generational workforce. As we speak, we have at least maybe 4 generations sitting out here, or maybe 5 generations sitting out here in this room. When you go back to the working population, you will at least have 4 generations together. So you will have the boomers, you have the Gen X, you have the millennials, and you now have a Gen 2020, as some of them call. So what they say is, if any senior in the company has passed out of college before I joined, he is not my generation. That's how the new generation defines the new generation. So if that is the case, we are having different kinds of people. How do you make sure that you have something in place from the corporate perspective? And a large part of what I'm talking about is focusing on how is India Inc. prepared for dignity at old age. So if you talk of these 4 generations, clearly just talking about, we have gratuity, we have provident fund really doesn't help, because everybody's needs are different. At one point in time, each one of us want some kind of a flexibility. So if you look at the next portion, we're talking about greater personalization. All of us want to have better control on what we get, what we need to do. We want to decide to be able to see what is it that, where do we invest. So we have people saying that, I don't want to contribute towards provident fund, which, many years back was unheard of. It was by default, everybody used to contribute to provident fund. Now we are saying that anybody above 15,000 has a choice. I may opt out of it. There are people who say that everybody wants cash. So companies are moving away from superannuation schemes. So there's a lot of personalization. People say, I want to decide what I do with my money. But we have to understand, when there is a personalization, there is an associated responsibility. So all of us need to educate our people that you get flexibility, fine, but are you able to handle the kind of exposure or the kind of responsibility that comes with the personalization. The third dimension, all of us, and I think we're talking a lot about managing money. Our research has indicated that a lot of people in the organization spend time worrying about how they will manage their money. Managing money is not just about retirement money. Managing money also means, can I afford to pay the installment, the loan installment? Can I afford that dream car I wanted? Can I go for a holiday which I had planned for maybe during November, December? All that puts stress on people's minds. So that's the third dimension. The fourth one, I think, which we cannot overlook, is caring for health. We know that all people feel that health is really vital for them to be able to have a peaceful life post full-time employment. I would not say post-retirement, I would say post full-time employment in some sense. But what are we seeing here? Whatever planning we do, I mean, we can have any kind of fancy models and assumptions, etc. What happens is, if there's any healthcare element, it really puts a huge dent on the post-retirement or any kind of income that I'm having. And the chances of me needing a health support at the age of 70 right now is way higher than what my mother would have or my father would have done a few years, the previous generation. And if you understand the Indian context, there is no real medical cover for most of us from the private sector. So one, we don't have medical cover post retirement or when we're not in active employment. Companies do give parental cover. So if I'm hoping that my child will join a company which has a parental cover, which covers me, that may not happen, because what we are seeing is the moment companies are under cost pressure, that's the first benefit that gets axed. So they all want to just do away with parental cover. So that's the second thing. And what also happens is there is nothing for the elderly. So while we're talking a lot on the coverage, it's all about hospitalization. What about long-term care? Everything does not need hospitalization. There's a whole lot of, and some of the actuaries who are there in life insurance know what long-term care products really entail. So we really don't have any such products in the market. So if given this kind of a background, I don't think we can talk of old age with dignity without these aspects also take. So it has to be a holistic approach. We have to necessarily look at, from a supplier side, look at ways in which we can actually have these kind of products for the people. Another point is on the post-retirement medical. Some of us may be familiar that every year when you value post-retirement medical, the company looks up and, at least the thought goes through their head, do we need to continue with this? Can we just do away with it from our balance sheets? So this is another challenge. So from a consumer side, these are all challenges that we really need to look at. So the last slide really talks about, this is going to be my last slide. So the previous one talked about the demand side. What is it that we need to do? Now look at the supplier side. Currently, what we have, if you look at the kind of benefits that we have in the corporate sector, and I look at three key indices through which I measure them, that is your adequacy, sustainability, and affordability. If you look at these three dimensions, we realize one thing. One, adequacy just talks about the extent to which, what I have as a saving is how is it good enough for me? Very simply put. Look at our systems, whether it's Provident Fund, whether it is gratuity. I have changed 4 jobs, and every time, I have just taken my gratuity and moved on. So it just doesn't, just sort of the compounding effect doesn't happen. We have easy access to money in India, and that actually just reduces the adequacy of the kind of pension system that we're talking about, for it to be able to help me in my my retiral days. The next one is about sustainability, the extent of coverage. So what we are having in India, if you look at the private pension plans, and a lot of this, just to give you a background, Mercer publishes an index called Melbourne Mercer Global Pension Index, together with the Monash University and the Victorian government every year. And a lot of what I'm talking about is an extract of that, just focusing only on the corporate sector. I have removed all the macro level country-specific elements here. So the second one on sustainability is about coverage. If you look at coverage in India, we're just about 6% people in the private pension plan who are covered. All of us want choices again, right? Everybody says that I need to be able to decide whether I want to contribute to Provident Fund. I'm not interested in superannuation. NPS, all companies who've implemented, they've realized it's a huge struggle to even get people to enroll. Anything beyond 10% is like a wow for them, that they've really done it right. That's the kind of level of engagement we are talking about in private sector plans. Gratuity is the only one which everybody has to stay with, but all of them are lump sum. So we really don't have a system. In India, which helps us to manage these kind of things at a macro level. The third one is about integrity. Integrity, I think we do reasonably well because we, though we don't have a minimum funding requirement in the country, but our governance mechanisms are sound in terms of making sure that the trust is exempt, where the monies lie, it's irrevocable. So there's a lot of governance aspects that get covered here. But surely, if you look at our entire system, everything is lump sum. So actually, then just to sort of give my final thoughts based on these dimensions, I think what we really need to look at is redefine retirement in some sense and just see what all is available. We obviously cannot just copy paste from any other country because each country is different, but we draw from their experiences. We see what works for us, use the existing infrastructure and the other programs that the country has in place to make sure that we actually have people actively engaged in thinking about living with dignity towards the end. Thank you. And I'll hand over to Kulin to give his final comments.
Thanks, everyone. I think I've got the simple task, given the esteemed speakers that we have on the panel today. And I think we've covered off, and what we've tried to do is cover off the IQ and an element of the EQ. I'm going to try and wrap this up, and for those who know me, I'm quite heavy on the EQ, and some would say on the GQ. And what I want to share is a little story. This conference today was quite apt. I actually spent the weekend before coming here dropping in and surprising a few old people in my family. No other sort of cousins, brothers, sisters, wives were there. So I spent the weekend with 3 70 to 75-year-olds, one 92-year-old, and referencing next-door neighbors who are downstairs at 90 years old as well. All related to me, all have known me since I've been a baby. And it got me really thinking about this. What does the old age and human dignity mean? We've been they've been fortunate enough to take care a lot of the basics and the financial income part of it, being very fortunate from where we come from. However, there was still a challenge. I heard stories about her friends who were from the UK who had to send one of their elderly relatives over to a care home just about 3 or 4 months ago in the UK. That's very new in an Asian family, something that now is starting to happen. Another story happened where they've had to send them back to another relative who actually lives in India. So the grandparent, a relative that I'm talking about, again in their 90s and of deteriorating health, had to be sent back here to be looked after by other sons and daughters, because the home care and the health can be looked after here much more longer and much more simpler given the practicalities of the world. And then finally, my grandfather, who's 93 years old, who I spent the weekend with, he hasn't been able to hear for about 15 years, and he can't actually see either for the last 10 years of his life either. And yet he's living a very dignified life. But then what's important to him, he's got all the money that God has blessed him with, and he's got all the infrastructure around him with all of us lot. So what has that meant to him? And it was very interesting doing that. And what it made me think about our talk today, and everything that the panel has said, is what does dignity really mean in old age? And I think it means different things to different people. And I think it will be different for different countries. It will be different for different cultural backgrounds, and it will be different for different socio-economic backgrounds. And hence, we've sort of covered the whole remit here on the panel today. I think countries have tried to tackle this. I'm not going to go into detail on the Maslow's hierarchy of needs, assuming everyone gets the concept of it. What I do want to share is a few examples just to refer to, not to say that these examples are the way to do it, or they're examples of way not to do it, but they are out there, and I thought I'd just quickly share how maybe over a period of time, different systems, different countries have maybe thought about some of these issues about meeting the needs of folks in old age. We have, for example, Singapore, in the organized formal sector, where it's mandatory for employers and employees to pay into the Central Provident Fund. Now, where it's different than what we're used to in India is in Singapore, right from the very start, you have an allocation of money that goes into a retirement account, a money that goes into a medical savings account, and a money that goes into a home access for home account, an ordinary account. And yes, they have very complex rules about being able to understand all that, and it's very, very complex to kind of administer. That's not my point. My point is just to link it to the fact they're trying to meet those various needs. Similar sort of construct, though a little bit more simpler, exists in Malaysia as well. Here, of course, Preeti's already referenced the Provident Fund. You can dip into it as and when life stages happen. Again, but though that's for the private sector or the organized workforce. We've heard from Gautam how I think, how do you meet those sorts of needs at a very basic level of security, food, water, shelter, through savings and very novel ways of referencing the innovative ways in which they think about meeting those first two layers. However, I think what I've been seeing, and back to the reference of the story that I shared at the beginning in my experience over the last weekend, was that for many, the first two layers and all our studies, our mathematics, our accumulation, decumulation, language over decades and decades have focused on the bottom two, and probably quite rightly so. There is a time, and there is a time in life that I've now been observing from the outside with these elder folks, and I'm always scared of saying this here because we have so many senior esteemed actuaries and senior members of elder members of our profession here, and they're experiencing it live. But I do feel that once you get on, I think the top three layers are ultimately what brings you the dignity and the satisfaction with what you've actually experienced. And in order for you to do that, you need the first two layers very strong and stable. The Age Concern organization and the Medical Health Foundation in the UK about a decade ago conducted research on mental health challenges of senior citizens in the country. These are 5 of the key things that they found that keep senior citizens awake at night and cause mental health problems and what they stress about. And these are some of the things that were new to me. Things around discrimination. How are they feeling with a society that's moving on, and yet how are they being viewed as elders, and how is that affecting their dignity and their view of everything that they've done in the 50, 60, 70 years before them? The other thing is participation in meaningful activities. That might be involve in human interaction. It might be, again, speaking to those top two layers of Maslow's chart there, which is around feeling that you've contributed and you're getting something in return that's actually more than just the financial aspects to it. Of course, relationships and those around you contribute a huge amount to your happiness. And in the absence of that, to the example that Priti shared, we can see what can happen if those sorts of relationships are not there. Physical health and poverty we've already spoken about, so I won't repeat them again here. It made me then think, then what's in store in the future? What's in store for us in the future? And what do we need to think about as actuaries, as retirement professionals in the industry as we move forward to the next 20, 30, 40 years? There is a study, I think a few studies have been done, but the one at Willis Towers Watson every couple of years goes on feet on street asking people about their financial priorities. One of the very direct questions is, how do you feel about your old age and whether you feel you will be better off than your parents? More than half, and this is done across a number of countries, about 30 countries, including India, and the range between all of those countries, both developing and developed markets, is that 50 to 60% of the respondents, every alternate year we do this study for the last 10, 15 years, has come out with about 50 to 60% responding that they feel that they will be worse off than their parents. It kind of gets you to think why. You've got now ease of technology, you've got all the consumerism and all that. So let's look at some mega trends that I thought of conceptually. One, falling savings rates because of consumerism and the desire for the here and now versus the later. And when you realize that the later is important, it's usually too late. Secondly, across Western markets and increasingly so, of course, in less developed markets and in ground roots society, the ability to afford housing and when you can afford that housing and the access to those finances for housing. So if you don't, in the future scenario of the way people are thinking that you don't actually own those assets necessarily, then how do you build up some of that financial security and shelter at the very bottom of Maslow's grid that's actually going to be give you the very basics? And then I thought of this sort of buzzword of the future of work and the future of labor mobility. What is that going to mean, where people are not organized, necessarily organized in a fixed geography, in a fixed occupation, in a fixed employer? How are they going to feel with that pillar of all the things that we've invented over the last decades and decades of Pillar 2, Pillar 3 sort of retirement schemes? How does that get impacted going forward? So I think that's where it spurred me into finally thinking about what potentially we could do more tangibly, and then I think it encapsulates everything that my esteemed guests and panelists, co-panelists have spoken about. One, it's very clear, I think actuaries have an absolute key role to play in being able to communicate, educate, and express things in a simple way, no matter who the audience is, whether it's a professional audience or it is the lady who Gotham spoke about, who is saving her one goat a year to do the inflation hedge. And for the more educated and fortunate, how to make it simple enough in markets like Sean and Professor Nielsen talked about. Secondly, design and manage products, financial products and potentially non-financial products that deliver services as the outcome, deliver the experiences as the outcome, more than just a stream of money and income that comes to you after your old age. And how do you phase that? I had a thought, of course, we all know about longevity, and you can see by now that in our last half an hour, 45 minutes, there's not been many figures and graphs on the pages, because we were sort of assuming that knowledge. We know that longevity is increased and increasing, though maybe at a slower rate going forward in many markets over the next 30, 40 years. However, it is long, And within old age, you're going to have different phases. You're going to have the transitionary phase that Priti spoke about, just less full-time employment. You're then going to have the phase that you actually want to take care of those higher order needs that I spoke about of Maslow. And then you're going to have the phase where genuinely, physically and mentally, your body and mind cannot keep pace with that, in which case you need the long-term care, you need the support, you need the services to support you around that. How can we think of products, explanations around delivering services as an outcome? Secondly, expand actuaries' involvement across various segments, and you've seen some of those segments here on the panel today, and I won't go into much more detail than that, just to say that's exactly one of the reasons we wanted the variability of the panelists today here. And then back to my previous slide, was developing approaches and thinking very clearly about our solutions being future ready. And that's where I think speaking and seeing so many of the younger generation in the room and the actuarial students and recent qualifiers in the room have probably a great role to play in actually understanding what all of this means and using your technical ability that you're learning to be able to help solutions that are going to be future ready. And then finally, making sure as we have got that mission, to ensure we've got that real place at the table, which we're all working on, and we can help shape public policy and social security plans increasingly so for the accumulation stage, but as I mentioned earlier, also about the decumulation stage or the service experience stage in old age to ensure that everyone's got dignity, security, and happiness in old age. And just to end, just so that you do have a number to take away with you, let's not forget, 2050, globally, 1.5 billion people over the age of 65 is what the projection is. So if we think we don't have opportunity about addressing that, hopefully that number tells you that we do. Thank you very much.
I think that we can all agree that that was an action-packed session, lots of panelists, lots of diverse views, and hopefully everyone here has gotten a lot of value out of it. We don't have much time left, but if there are a couple of questions in the audience, we probably have enough time to take those. Is there a mic that we can get down here? The mic is coming.
Good afternoon, everyone. My name is Manisha Panale. The question is in respect of the micro pension scheme. So basically, I just want to ask that how do we deal with the problems specific to the unorganized sector? So the income stream is kind of discontinuous in unorganized sector. 1 month a person may be able to contribute, the other month they might not be able to. So in that case, what will happen to the pension account? And the second one is recently the PM has announced the Pradhan Mantri Shrama Yogi Mandhan, which actually gives you the exact amount that will be paid at the age of 60 once the contributions have been made. So will these kind of schemes create a competition or overrule, because it is very difficult to educate the unorganized sector that how much exactly is the amount that they are going to get if at all they contribute in the micro pension scheme. So how do we deal with these kind of questions?
Thanks for your question, ma'am. So I think part of the answer as far as the informal sector is concerned is around how do you design products which make sense. Now, while people have small incomes, I think the bigger problem that we are facing in most of the countries where we're working is that people don't have insurance. And so as a result, what is really happening is, while I want to save and I have some ability to save, the challenge for me is that I am exposed to the same life cycle risks as, let's say, all of us in this room. But I am, because I'm a farmer or I'm a street vendor and I don't have insurance, I'm actually paying 100% of the cost of each risk that comes up. You know, So if I have a health shock, if my crop fails, my cow dies, my child is in hospital, I'm paying 100% of the cost of the risk. Now, if we could include insurance as part of pensions, you'll find that people's ability, because they don't have insurance, they're using past savings as a proxy, for insurance. So every time some event happens, which it will, they're using past savings to pay for the risk. And when those savings are not enough to cover the cost of the risk, then they end up going for emergency loans. And when you combine these two, then what is happening is, one, I've wiped out any past savings that I have. Two, I've mortgaged future earnings towards repayment of very expensive debt. So it sort of disturbs the ability and compromises the ability of informal sector people with intermittent incomes and modest incomes at that from saving for old age. So I think part of this is at the level of product, at the level of process, and so on and so forth. And part of this is at the behavioral level. So, and in terms of architecture, to your question, if I join a pension scheme, then ideally I should never lose my benefits. So if you have a unique identifier like Aadhaar or the national ID in any of these countries, as long as my pension account is pegged to a national ID, I don't see any reason for us to not be able to let the savings that have already come in to stay invested and to make sure that the individual never loses those savings. I don't know whether that is...
Thank you. Do we have another question?
Yeah.
Yes, sir.
I'm G.N. Agarwal. And actually, my question means I want to just add what Preeti and Colleen told about going beyond the income level, means assistance and care taking. So I think some such system has been developed in Switzerland, where actually younger people are encouraged to actually help the older people. And they actually means by serving the older people, not of their love and affection. Beyond that, they earn actually some hours in a year, which actually they can be government can help others to help by actually ensuring that means they get assistance when they become old. So I think some such system can be thought of to actually take care of beyond income level. Hours time.
I think that's a good point, and I know Professor Nielsen was talking about some such thing in another country where it's not just scoring brownie points, but it actually translates to something tangible and really helps both parties. The younger people also, and I think as a part of living, a feel-good factor is really, really important for all of us. So that helps the younger generation towards a feel-good factor, and it also, and obviously not going beyond that, it just gives you some kind of credits which you can use elsewhere, but it also helps the older generation. But I think this is very, very critical, and we are seeing a lot of us are personally experiencing this, that it's not just about money, it's about being there or having some support, because you leave a old parent at home, you're forever worried as to whether they're being looked after very well, because there's really no long-term care facility. And if you get something from private, that's another worrying thing, just leaving them behind in care of somebody else. So I think there is something that needs to be done from the infrastructure perspective. And I think the actual community should really get together to go back and, help at least initiate such a system in place.
I actually think that we've run out of time this morning, so I have to thank everybody for their attendance. From my perspective, I started off by talking about something quite academic. Professor Merton, he's a well-known academic, but at the end of the day, he'll call it, he sits in his ivory tower of the university and he writes something in a publication, and it seems abstract, quite foreign. When you start looking at the presentations, that video that Gautam put up, it really strikes you in the gut. And then Preeti stands up and puts the picture of the couple, and then you have Kulin sharing his own experiences with his grandparents, and it goes from something quite abstract, foreign, it seems it's not going to happen to you or your family, and then it comes right close to home. And I think that pensions, dignity, and old age is something that impacts on all of us, and if it's not something that we're experiencing now, it's a family member, and it will happen to us at some stage. So hopefully those in the room that are not directly involved with pensions got value out of it, can see the opportunity to bring insurance in, then that's a common theme that was brought in, and get involved, because I think there is a lot of value to unpack here, and a role for actuaries for many years to come. So I'd like to thank our panelists formally. I think there's some mementos that I'm going to hand over to them. Professor Nielsen received his yesterday, so I'm not going to present him with another one, but to thank him for his time. I'd like to thank Priti Chandrasekhar. Thank you for your time. I'd like to thank Gautam Bhardwaj. And finally, Kulan Patel, who did so much work behind the scenes to coordinate our panelists and put the work together. He's excellent. Thank you all. You've been fabulous. Have a fantastic day.
And just to let you know, Sean also got his gifts yesterday. But a big round of applause for Sean picking this up and coordinating everything with us. So thanks very much, everybody.